Hello and welcome to Fidelity Connects. I'm Glenn Davidson. We begin today looking at global developments like Ukrainian President Zelensky and several European leaders being in Washington for ongoing discussions, as well as the upcoming Jackson Hole Economic Policy Symposium. In the markets, Chinese equities are climbing. Shanghai-listed stocks just reached a 10-year high. Treasury yields are drifting lower. S&P 500 futures are steady. And Bitcoin has broken through a new level. Joining us to unpack these developments and what they mean for you and your clients is Fidelity's Director of Global Macro, Jurrien Timmer. Welcome, Jurrien. Thanks so much for joining us today.
Good morning, Glenn. Nice to see you.
Likewise. And you're busy looking at all the global developments, what's happening in the markets, but you're also trying to make sure that everything's coming into place for Burning Man, because you're off to Burning Man tomorrow, and I think it's your 7th year. Everything coming together okay?
It's my 7th year. Yes, and so I run a food camp there, and actually today is the first day that the setup crews can show up, and my crew of about 20 is there since about an hour, so I'm actually multitasking from a distance, making sure that the vendors are showing up, the generators being delivered, the compostable toilets are being delivered, very important, and all of that good stuff. And then tomorrow we drive to Sacramento, and then on to Reno, and then on to the Playa. So we'll be there on Wednesday, and then we'll be there until September 1st. Hopefully we get out in one piece, and but looking forward to it. We're looking forward to making about 7,000 meals for the artist and the community at large.
That's amazing. What's the one meal that you're looking most forward to making?
Oh, we have so many. We have literally meals from every nationality. We have, Taco Tuesday. We have a Filipino dish. We have a Lebanese grill. We have Italian. We have a crew from Hawaii who makes an amazing Hawaiian barbecue. That might be my favorite. Having poke on the playa is always very tasty. So.
Sounds pretty good to me. Now, you're going for 2 weeks, so we'll see you in a few. But what's been the benefit to you from getting off the grid for a couple of weeks? You've been doing this, as I said, this will be your 7th year. How's that helped your creativity and thought process?
So I think it helps reset. We're in this mode. We are always sort of chasing market data and getting on airplanes and presenting and poring over spreadsheets, making charts, which of course is all great stuff. I love every minute of it. But you do get to a point where it gets a little hectic, and then summer arrives. It slows down a little bit, of course. But this is sort of my right brain reset, if you will. We're all kind of operating in a left brain type of world. And, when I started going in 2017, obviously it was about the spectacle and the lights and the sounds and people and just kind of that stimulation overload of like seeing all these blinky lights and things like that. You get a little jaded after a few years. It's like, okay, been there, done that. But for me, what's really special is it's just the people. Like my camp that I run, we have 90 people from all over the world, every walk of life, every background you can imagine, and this is the highlight of their year. Like this is kind of the pinnacle of what we do. So we fly in or drive in from all over the world, and we make magic happen through food, and we bond with this community, and that to me is a very nurturing, grounding experience that, when we come back in September, and in our business, September is like New Year's Day, right? It's sort of like, that's kind of when the year reboots after the summer. And so it just gives me a fresh creative perspective, and you kind of take a fresher look at everything, and hopefully it makes for a better product.
Wonderful. So let's bond with the investment community while we still have you. And why don't we start with earnings? Big box retailers are listing their in the news this week relative to what we've seen in technology and so on. What do you think they stand?
Well, if we go to slide 7, so the big story with earnings is that so far with the tariff tantrum, it's been the dog that didn't bite. It barked, but it didn't bite. And so you see the black line, that was the second quarter earnings estimate over time for the S&P 500, and that estimate peaked at 68 back in November, and generally there's a downward drift, as you can see from all those squiggles on the chart. But of course, in April, we got the markdowns because we had the whole April 2nd, Liberation Day thing going, and then we saw how bad the tariffs could get, and then the numbers got marked down, and then we got sort of the tariff story put on hold. We got that 90-day reprieve, and then we got the big beautiful bill, and the numbers started coming back up again. And so you can see with that black line that the realized earnings number for the second quarter actually jumped $4 from the estimated number. And so if we go to the next slide, 8, you can see the same idea, but on a calendar year basis. So these are the growth rates. And you can see the same thing here, right? The growth rate for 2025 at the beginning of the year was 12.4%. It got marked down to 7.2% in April, May, and now it's gotten marked up again to 9.2%. So whether there's another shoe to drop on the earnings side or not, we don't know. In terms of the tariff side, I mean, the tariffs are, of course, a tax. Someone's going to be paying for that tax. But so far, whatever impact we're seeing from tariffs is being offset by the big beautiful bill and just sort of animal spirits in general. And so that's a good story because valuations are high and you need the earnings side to really come through, and that's happening in a pretty big way, not only in the US, but overseas as well.
Do you feel that the earnings may be impacted by tariffs, though, for a lot of those retailers and eventually passed on to the consumer as an additional tax, really?
So our sense, and we've done some work on this internally, our sense is that only 1/3 of the tariffs have actually been passed through to the economy, right? Because companies front-loaded their imports, so they're selling products that didn't have tariffs on them before they do with the ones with the tariff. So we have not felt the full impact yet, or even part of the impact, only about 1/3. And of course, with these kinds of things, there are always offsets, right? Even with the inflationary aspect, you have to measure what consumers would pay more for stuff against, how much they're saving from reductions in other prices, like oil prices, for instance. So it's very hard to kind of to really clearly see the impact of something because there's a whole ocean of things going on. But so far, our sense is that we haven't really seen the full effect yet, and it could hit margins. But again, margins could be on the rise for other reasons, and it could all be a wash at the end.
As you said, it could be this, could be that. We don't know what we don't know. When it comes to tariffs, obviously, on that Bristol board from quite a few months ago, there were some very big numbers floated. That got everybody's attention. Those numbers have come down for the most part. We have some European countries saying, I'm not so happy with the deal that the EU has struck. Do you think that dissension will cause some gyrations on the tariff side?
Well, I mean, nobody likes to have tariffs imposed on them, and so we've seen some of these deals, and whether they're actually deals or just arrangements that let certain sides, claim victory. But it's an import tax, and someone has to pay for it. And again, I think politically the thinking is that the countries that the tariffs are imposed on are the ones going to be paying the price. That's certainly the political argument. But again, our analysis shows that that's not really the case. So it could be that the countries that are complaining may not have that much to complain about, and that eventually it's going to be borne on U.S. consumers.
Keeping with that international theme, you made a comment in a post last week about do we keep focused on the Magnificent Seven and then try and figure out the S&P 493? Or do we just say, let's go market cap and then market weight and then go global? And that's a better way to round out a portfolio. Do you want to talk about that?
Yeah, it's really fascinating because we've talked, for several years on this show about will the market broaden beyond the Mag 7? Will the rest of the S&P 500 participate? And could the international rotation that so many of us have been looking for, the global rotation out of US stocks, could that happen in a bullish way where the rest starts participating? Or would it be in a negative way where it would come at the expense of the Mag 7? And the Mag 7 are so big that if they go down, the market goes down, right? Or the index goes down. And it turns out we're kind of getting our cake and eating it too at this point, right? So if we look at slide 2, that's of course the S&P 500, and you can see that's a very healthy uptrend. The S&P is trading at new highs, but of course that's going to be heavily based on the Mag 7, which is in slide 9, which continues to be powered by the whole AI boom, and you see that the earnings, those three bands, are still pointing up. We now have several $4 trillion companies. I think Microsoft and Nvidia alone are now 15% of the S&P, right? So this remains a very top-heavy market. And if we go to slide 3, you can see that if you look at the S&P equal weighted index, so obviously the 500 constituents are weighed equally instead of by cap, you can see it's still a nice uptrend, but the S&P is, the equal weight is not at a new high, although it might be, today, who knows. But if you look at this chart, this actually is a pretty good looking chart because the trend is up, as it tends to be for equities. The index is at the trend line, so it is not particularly overbought or oversold. And then if you look at the bottom, you see the PE ratio, both for the cap weighted S&P in the purple, which is trading at 24 times expected earnings, and the equal weighted PE, which is at 18.3 times earnings. And again, looking just at the equal weighted now, the PE is, 1 point above its average of 17, but that's hardly, nosebleed levels, right? So you look at the SPW, which is the equal weighted index, you're on trend, the trend is rising, you're not overbought, and you're not particularly expensive. So the overall market, once you kind of strip out those Mag 7, is actually in pretty good shape. The problem is the Mag 7 are so big that if for some reason the AI boom turns into a bubble or these companies start, losing share of some sort, the overall index is just not going to be able to hold up. But while we're talking about the US, if we look at the non-US market, so let's look at slide 11, this is a really good story as well. So this is the MSCI All Country World ex-US. Again, a solid uptrend. You're kind of on the trend line, and that trend is up whether you measure this index in US dollars, as MSCI tends to do, or in local currency, which is the blue line. That trend is up. So this is a global bull market now, which really was not the case for some time. And you look in the bottom, 74% of the stocks outside the US are in term uptrends. They're above their 200-day moving average. And so this is a good story, right? Because we want to fish in the biggest possible pond when we are either picking stocks or allocating assets, which of course the audience on this call does for a living. And you don't want to have to be stuck with just 7 companies that's very binary, right? If they do well, you're a hero. If they don't do well, you're falling down. So the good news is that the rest of the US market looks good, and the rest of the world actually looks pretty good. And I'll just take us one step further, if you don't mind. If we go to slide 12, so one of the things about the U.S. versus non-U.S. dominance over the years has been, and I've been, very vocal about that, is that yes, the U.S. is more important, more expensive. It trades at 22 times earnings. The rest of the world trades at 14 times earnings, but that premium was deserved because the U.S. was outpowering the rest of the world, not only in terms of earnings, but how much of those earnings were returned to shareholders. And that's called the payout ratio, right? So you have earnings growth, like let's say it's 10%. And if a company or an index has a payout of 70%, so 70% of that earnings number of 10% gets returned to shareholders either as dividends or as share buybacks, that's better than if a company or a country grows earnings by 5% and only returns 50% of that 5% to shareholders. So that's kind of how the math works, and you plug that into a discounted cash flow model. And so the story has been for years until very recently is that the US was outgrowing both developed and non-developed markets, and it was also returning a higher percentage of those earnings. So it was like a double whammy of the US just dominating everything else. And of course, the Mag 7 was a big part of that. But that's changed, right? So emerging markets are still kind of left behind. So that blue line in this chart is the payout of EM earnings, and the blue bars at the bottom is the payout ratio. So the payout hasn't really grown in, God, like almost 20 years. It's like 37 today. It was 40 in 2007. And the payout ratio is only 46%. And that's because emerging companies tend to not buy back a lot of shares. If anything, they tend to dilute shareholders because they are emerging companies, they're issuing shares, et cetera. Now, the US, which is the gray line, of course, has grown its payout from $40 in '09 to a much higher level today. And it's paying out about 76% to investors. But look at EFA, so non-US developed stocks in the orange line. That has really shown a lot of growth in the last year or two. And its payout ratio is actually now higher than in the US. It's at 77%. And the mix of that payout is different as well. So in the US, it's about, let's say, a third is dividends, 2/3 is buybacks. In Europe and Japan, it's the other way around. It's 2/3 in dividends, 1/3 in buybacks. So the bottom line here is that EFA is now competitive on both an earnings growth side, a payout side, and a payout ratio side. And if we take that just to one next chart on slide 13, if you put that into a scatter plot, which I always like to do, and we look at the horizontal, which is the payout ratio, right, to the percent of earnings paid back to investors, and the vertical axis is the PE ratio, right? So the US 76% payout, a 22.5 PE ratio, and the earnings growth or the growth rate in the payout, the 5-year growth rate is 6%. Now you look at EFA, 77% payout, a 14.9 PE, and 10% growth in the 5-year payout. So to me, the valuation premium of the US over non-US developed markets is no longer justified. And that doesn't mean that the US has to go down because it is fueled by the Mag 7, but it tells me that non-US markets have some room to catch up here by earning a higher multiple. And that is a big opportunity for investors who have been kind of stuck having to play the US game for the last 10 years because that was the only place to get returns. And now, again, that pond is bigger and it has more fish in it. And that's a good story.
Interesting comparison, and I can also see how your thought process evolves when you go to Burning Man so that you can create even more interesting charts.
Hello investors, we'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
So quite a gap there, as you said. Rates will play into that as well. And it's been interesting to see the steepening of the yield curve and bets that the Fed is going to reduce interest rates in September. What are your thoughts on where we stand in the next few weeks?
Yeah, so obviously the Fed and the Fed's hard-fought independence over the many decades obviously become issue here as Chair Powell gets ready to at least retire as the chair of the Fed. And we can pull up slide 15 here. So, the inside scoop, of course, is, as we all know, is the president doesn't like Powell because he is not dropping rates fast enough. And Powell, I think, is doing exactly the right thing by not, playing into this game because it's a very dangerous game, right? The U.S. is the largest economy in the world. It does have still the dominant reserve currency. And you can't have shenanigans with central banks not conducting policy in an independent way. And so when you look at the Fed. So the Fed is at 4 3/8. The forward curve expects the Fed to cut rates to about 3.25% over the next couple of years. I think that's ambitious if the economy remains relatively resilient, which so far it has. The Fed is saying it's going to eventually go to 3%. Those are those pink dots there. And inflation right now is at about 2.7. So to me, a neutral policy is justified, right? Inflation has improved. It remains pretty sticky above 2%, but it's closer to 3, but at least it's relatively stable there. So the volatility of inflation has come down. And on the growth side, the economy seems to be neither too hot nor too cold. If you look at the unemployment rates, 4.2%. If we think about what the natural rate of unemployment is, it's also around 4.2%. So labor market seems to be in balance. Inflation is stable, but above the Fed's target. So the Fed could go closer to neutral, which in my view would be inflation plus 100 basis points. That gets you to 3.75. Fed is at 4 3/8. So the Fed can cut several times, but not really much more than that. So a September rate cut seems to be in the cards. I think that's fine, and maybe another one later this year, but really not much more than that. So when the president says the Fed is three percentage points too high, that would imply that the Fed would cut to 1 or 2%. An economy at full employment with inflation above target, there is no way that that's justified, and I'm sure the president knows this, but he's doing his thing. But where this becomes interesting is that next May, Powell steps down as the chair. He still has 2 years left after that on the Fed, and it's a question of whether he actually resigns from the board as well. And the only reason that's important is because if he resigns, a new spot opens, which can be filled by another, a White House friendly candidate. And so there'll be some politics around that. But in the meantime, I think President Trump is about to announce the next, his candidate for Fed chair. And, we got Jackson Hole coming up in a few weeks or next week even. And so we could get into kind of a political theater, if you will, where the next chair is announced like in the next couple of weeks, while the current chair is still chairing the Fed. And for the next 6 months, we could have essentially 2 Fed chairs, one pro forma Fed chair and one who is on his way out. And it shouldn't have to be a big deal because I think both Fed leaderships, incoming and outgoing, are inclined to lower rates somewhat. But the incoming one would want to lower it much more, of course. And so there will be some battling in terms of who has the loudest voice and which one affects the market and how much support that person will have at FOMC meetings. So I think we're going to be spending some time in the fall, playing these musical chairs at the Fed, and so it'll be interesting. But the bottom line, Glenn, is that if the Fed were to lower rates more than is warranted, the Fed is among the least accommodative central banks on the planet. You can see the various central bank rates there. So if the Fed were to start capitulating to political pressure and falling and dropping rates even further, you would imagine, or I would imagine, that the dollar would go down further. So that would be outcome number one. And outcome number two would be in slide 18, and that would be, of course, the long end of the yield curve, right? The Fed controls the short end. It does not control the long end unless it is also flexing its power on its balance sheet, which it hasn't been doing for the last couple of years. But if the Fed were to lower rates too much, more than is warranted, the yield curve could bear steepen, as we call it, and then you could have yields approaching 5%. And I can tell you, markets are not going to like that if that happens. And if it did happen, caused by a rising term premium, which you see in the bottom panel there, the Fed probably would have to come back in and use its balance sheet through yield curve control to try to push the long end down. And so then all of a sudden, again, this is all theoretical, of course, but let's say we're in 2026, Powell is gone, the next person is in. we could have a Fed that's not only easing too much, but also flexing its power of its balance sheet by pushing the long end down. And then you get into a pure form of fiscal dominance where fiscal policy dominates and monetary policy kind of plays a more supporting role rather than the independent role. So these are all the things we have to contemplate, as we navigate the next, 3, 6, 12 months.
So many permutations and combinations. Some quick comments on your gold Bitcoin pairing that you've discussed in the past.
Yeah, so let's go to slide 19. So the good news in this new kind of model where the equity market has broadened, the bond market is okay, right? Investors are getting a positive real yield, but the bond market could be somewhat impaired as a safety asset, especially if the term premium rises. So then you want to look in a more broader sense of how to construct a portfolio. And so we can see here, like the Mag 7 is at the top, Bitcoin is second. You have a whole bunch of international markets that are now doing better than the S&P 500. And at the bottom is the dollar, and close to the bottom are long-term treasuries. So if we go to the next slide, you see Sharpe ratios, right, which are risk-adjusted returns over the last 52 weeks using weekly data. And you can see, treasuries and the dollar are at the bottom, gold, Bitcoin, high-yield bonds, various alternatives like market neutral, absolute return, China, emerging markets, they're all very competitive and more so than the S&P. And then you want to look for assets that are obviously competitive from a risk-adjusted return perspective, but also diversifiers that have low correlations to both stocks and bonds. And gold and Bitcoin definitely fit that bill. And so if we go to slide 23, the way I think about gold and Bitcoin is that I look at gold and Bitcoin on a 4-to-1 ratio. So in other words, if I were, and this is not investment advice, but if I were to put a bucket of sort of hard currency, hard money, store of value in a portfolio, and let's say that number was 5%, 4 of that 5 would be in gold and 1 would be in Bitcoin. And I do that so that I essentially equalize the volatility of the two assets. And if you do that on a 4-to-1 basis, you can see in the top panel that Bitcoin and gold actually are very, very close to each other in terms of their performance, and their Sharpe ratios at the bottom are also fairly similar. And so that's how I look at gold and Bitcoin. They are a play on fiscal dominance. They are a play on a loss of Fed independence, which we don't have yet. So I don't want to jump the gun too much. But if we go to slide 25, and I know we're running out of time, you can see that Bitcoin is making new highs pretty much as we speak, and it's following some pretty good technical patterns here. And so up and to the right as far as Bitcoin is concerned, as well as gold.
Jurrien, if I recall correctly, when you went off for 2 weeks last year at this time to go to Burning Man, it was quite calm in the market for those 2 weeks. I don't know that that's going to be the case for the 2 weeks that you're going to be off the grid. How do you get back up to speed when you get back at the desk? Because you're connected to the global asset allocate. You're connected to everything, and you have an amazing amount of information coming to you. How do you get up to speed?
Slowly.
Makes sense.
So it is 2 weeks, but it's also the end of August, so it is a vacation period, right? So that's good. And like I said, Labor Day is kind of like New Year's Day in the market. So I take the week of Labor Day and I just get back up to speed and I don't rush it. Markets are not going anywhere. If we have good portfolios, we can afford to take a few weeks off. Obviously, you're all going to have customers calling, but the answer is slowly, and that's fine. We all should take some time, especially when markets are hopefully quiet, to just kind of ground ourselves and reset and take some distance, because everything makes more sense when you look at it with fresh eyes.
Thank you, and on behalf of everybody, we wish you a safe and happy Burning Man. So safe travel.
Thank you very much.
Thank you for joining us.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.